Hi, it's Dak Hartsock back with a performance update on process portfolios for year-to-date 2016 through April 15th. I'm going to try to get through this a little faster than normally in the interest of the time commitment it sometimes takes to get through my videos. If you need to learn more about me, just visit dakhartsock.com/about. And let's step into the executive brief. I've front-loaded this thing, so all the real performance data is in the first 4 or 5 slides. This executive brief will get a little bit of color, and then after we get through some numbers, if you're interested, you can stick around in the video to get a little explanation, a little color for some of the things that we're thinking about as regards to the market and the portfolios. And then you could also fast forward in the video past the color section and get the market outlook for what I think is coming down the pipe for the rest of the year at this point. So quick summary, portfolios doing okay so far this year. 4 of 6 are beating their benchmarks. 3 out of 6 have outperformed the S&P, which is kind of nice to see. Very strong performance in market income, full cyclable and durable opportunities. Durable opportunities in particular, it's nice to see a uptick in performance because there were some adjustments made in the second half last year, and I think those are beginning to take hold. A little bit of color on core equity. For those of you that don't know, that's a diversified kind of holding or portfolio rather, that has historically beat the S&P by about 5.5% per year. Since 2007, we learned that when we did back testing before it switched this into a live portfolio. It held up really well during the crash of 2008, and that's why we put it in place. It's having some issues because biotech and pharmaceuticals have been targeted by the politicians and the media, and there have been a couple of bad apples that have come to light in the industry, and of course, that's something that politicians and the media jump on. So they've been beaten up very seriously in the last few months, and it's actually spread to healthcare as well. The thing is all three of these sectors are normally defensive, and biotech in particular had very good earnings growth last year. So that kind of to me says that despite the fact investors are rattled, despite the fact there's been some capital flight from the sector over the last 2 quarters, in point of fact, biotech at one point was down over 50% from last year's high, which is worse than it did, significantly worse than it did in 2008. But I think what's going to happen is once we move past this election rhetoric, we're going to see that this portfolio is going to be positioned for a potentially strong recovery in 2017, and it may even happen before then. And those of you that saw the last update, you know that some adjustments were planned for fixed income for the first couple quarters of this year. Those are probably going into place in the next probably 30 to 60 days. Already had some adjustments to that in the last week. Lastly, the recession probability indicator is currently saying the investment environment is stable. Doesn't look like we're on the verge of recession. Of course, that's subject to change in any given month, and I'll keep you updated as we get farther into the year. Quick summary of the various asset classes, how we did here. You can read this yourself. What's interesting is if you look down at the bottom where the pointer is, the mouse pointer, you see gold, treasury bonds, and the aggregate bond markets are doing very, very well. And that's because we actually had the worst January that the market's seen in something like 82 years. And that created a lot of fear, a lot of volatility. I think it came in the wake of the Fed announcing they were going to raise rates. It created a lot of fear, but that's where you get this type of performance for more seasoned investors. Bonds don't do this. So that tells you something's out of whack with the way the market is working, and likely there's going to be an adjustment as some of that fear bleeds back out of the market and people realize the world is not about to end. So that's my take. Here's our consolidated live portfolio performance. For those of you that aren't clear, consolidated just means this is the results across all client dollars that are invested in these portfolios, and this is net of fees, meaning it includes all transaction fees and all management fees and so on and so forth. It also includes dividends. So what we see is core equities lagging a little bit, not too much, but it's fallen behind the S&P and a mixed stock bond portfolio. And most of that happened in January. In January, the biotech segment sold off about 25%. Pharmaceuticals wasn't too far behind that. Healthcare did not have an easy time in January and February. And those three sectors, because they're normally defensive, are about 40% of core equities portfolio holdings. I'm not really concerned about it at this point. We may see some more up and down in this as the politicians, get their media time and things like that. But the bottom line is, if you look at this portfolio and look at 40% of it just getting massacred, down 15, 20, 20% or more, then this is holding up really well. So that says that when this kind of passes, this little tempest we've got in these sectors passes, this portfolio is likely to do reasonably well and perhaps even return to the kind of outperformance that we've seen in the past. Like in 2015, it outperformed the S&P fairly strongly, and historically it's done a lot more than that. So market income continues to shine. Had a very good first quarter with a 4% number, and that beats the benchmark, the model, and the market itself, which we like to see. It's quickly becoming a client favorite, as you may imagine. Full cycle portfolio, a pretty good quarter. Not doing too bad. It beat both the model and the benchmark, and has also beaten the market, and that's nice to see, even though it's not really designed to do that. But at any rate, it's nice to see that kind of performance. Durable opportunities, a good quarter. Again, beat the benchmark and the market. And then market momentum is having an okay start to the year. I'm expecting some better numbers out of this as we get farther into the year, assuming we do not have a recession. But we'll see how that plays out. But so far, it's not too bad. It did really well in 2015, so hopefully we'll see that continue in 2016. Certainly it should. Fixed income is not doing stellar, but this entire portfolio is going to be restructured. As a matter of fact, it's in the process of liquidation, and we're going to re-engineer everything, put some research into how to do fixed income a little bit better, and I think it's going to pay off. This isn't a terrible performance, but it's certainly not where we'd like to see it. So this whole portfolio is being re-engineered. Here's consolidated performance for 2015. For those of you that would like to see it, I'm going to go ahead and skip this so you can pause the video. And now a little bit of color for those that were just interested in basic numbers or the market outlook. You can fast forward to the end of the presentation for the market outlook. But as you can see, a lot of damage done here in core equity in January and February, and this is almost exclusively on the backs of biotech, pharmaceuticals, and healthcare. But you also see that as we move forward in time, it begins to make the ground up. And this chart looks very different if you look at just February or March or April. So better performance for each of those months and continuing to gain. So I think 2017 is probably going to look very different, barring recession, for core equity, and possibly earlier. We'll see how it works out. Market income is the blue line, and as you can see, it's doing exactly what it's built to do, just like it did last year. It kind of damps down volatility a little bit when the market's selling off. Generally, it doesn't go down as far as the market. In this case, the market itself, the S&P 500, is the purple line for comparison. And then when things are better, it has a tendency to kind of motor up a little bit more aggressively, and that's also what we like to see. So far so good with market income, and this is a trend that should continue. Full cycle, very good first quarter. Didn't go down as far as the multi-strategy hedge fund, or close to it, during the sell-off, but then motored straight back up and at a more aggressive pace. So that's nice to see. It says this is working, and it's really firing on all cylinders so far this year. Durable opportunities, for those of you that remember last year, this is a much better picture than we had last year, and that suggests that some of the adjustments that were made are taking hold. At some point this year, ideally, we'll have another pretty severe deep sell-off, and that will allow us to get some more dollars to work in durable opportunities and get this thing fleshed out. We were not able to buy everything we wanted to buy during the last sellout. Some things just didn't get quite low enough to hit our triggers, but maybe we'll have another opportunity later in the year. Market momentum is again the blue, and it's not doing bad. It's beating the market by and large, except for the last few weeks when the market really surged. But its risk profile is kind of right in there in between a mixed stock bond portfolio and the market. So it's working out so far. I'm expecting a little higher performance, as I said, later in the year. The assumption here, of course, being that we do not have a recession. Fixed income, ideally, this is the last time anyone's going to see a chart like this out of fixed income. It's already begun to be liquidated, and put some research into how to better position this and take a little bit less risk and ideally get a little more reward than we're seeing from the average fixed income markets, be it the aggregate bond or the total bond markets. And I think we're going to see that moving forward, but we'll see. Current outlook. There's a rising possibility of recession. We do not have a signal yet. I keep everyone updated, as you know. The Fed continues to appear interested in supporting economic stability, but also market stability, and not necessarily just U.S. markets. So, the rhetoric lately has been a lot of talk about what's happening globally and the bleed over effects that are possible into our economy. So I kind of expect the Fed to stay pretty dovish for the rest of the year. We might see another raise in September, possibly December. I don't think we're going to see one in June, but anything is possible. We've got a very unpredictable Fed. They just muddy the waters every time somebody opens their mouth. So, but I think that they're not going to do anything too aggressive. Also, even if they do raise rates in June, it's probably going to cause some shorter-term volatility, which will be an opportunity, barring a recession signal. So we'll get some money to work if that happens, but the economy's more than able to handle a little bit of a rate raise at this point. So, no real worries about it at that end of things. I think oil prices have a likelihood to fall again, perhaps a little bit before the second half. That may or may not renew concerns about credit markets. Even if it does, I just don't see that's likely to cause a financial crisis or a recession. I've looked at some of the numbers of bank exposure to the energy companies and energy markets in terms of loans made and all of that, and they're measurable, but they're not so big that they should pull the system down. But we might see again some media noise about that. I think it's just noise, so not worth paying too much attention to, I don't believe. What we're seeing in the sector is that supply is beginning to drop, especially from American operations. We've cut capacity massively in the last 12 months. We may see the Iranians get some more oil on the market. We may see the Russians get some more oil on the market. I'm not sure, but regardless, demand continues to grow because the global economy and the U.S. economy, while not incredibly strong, are still somewhat healthy and moving along. So we may begin to see some consumer tailwinds from oil prices in the second quarter. Usually there's about a year or so lag before that happens, so we're coming due. We should start to see some of the consumer savings on oil and things like that find its way into the economy, which is supportive of earnings and consumer spending and things like that. So that among other things, I think we're going to see the economy strengthen moderately in the second and possibly third quarter, and that should support earnings and therefore asset prices. And combine that with the dovish Fed, and we should have an okay year. I'm not expecting any great things out of the market. As I've said, I think most of the gains are going to come from income and income-generating activities, things like dividends, things like the market income portfolio, the way that's structured and designed to work, and also the equity builder overlay that we use sometimes with core equity and durable opportunities and so on to get a little more return out of the market when it's possible. No idea what's going to happen with the presidential impact or election, rather. If anybody's got a really good idea of how this is going to play out, regardless of who gets elected, I'd love to hear it, because I'm not the only guy sitting back and wondering exactly what's this going to do to the economy. What effect is it going to have on the market? It will be short term. That's about all I can say about it. So that's pretty much the end of the meat of the presentation. Went a little longer than I'd hoped, as always, but thank you very much for the time. There is additional information on my firm and I available at these sites. And here's some explanation about the different models and portfolios, how they work. And then after this, we'll have some disclosures. I'm going to give a couple of seconds for each of these. You can hit the pause button if you want to learn more about each of these portfolios. But I've got them all listed here. So there's market income. Here's full cycle. It's a risk parity portfolio for those that may be interested. So that means it's kind of divided up into 4 quarters, if you will, within the portfolio itself, and each of those investments is designed to prosper during a different phase of the economic or the business cycle. And it's based on Ray Dalio's all-weather portfolio, which he's used at Bridgewater Associates to build basically the largest hedge fund in the world, excluding Berkshire Hathaway. And it's a nice portfolio because even the crash, it only went down about 8%. On the back-tested basis, and it's not going to go gangbusters. The most you can expect out of this portfolio is maybe 8% per year, but it's just a very reasonable risk for reasonable return. It's not spectacular in terms of what it's going to earn you, but it's also not going to experience or shouldn't experience spectacular falls. So this appeals to a lot of clients. A lot of university endowments and sovereign funds and things like this like to invest in this way. So durable opportunities, and again, hit pause if you want to learn a little more. Here's market momentum, and lastly, fixed income. And the structure of this will be changing very, very shortly. And that's it. So now we're into disclosures. I will be cueing the theme music. Thank you very much. Give a call to the office or send an email if you've got questions, and I'll talk to you again soon. Thanks.